Trump is losing the trade war with China and the EU, based on his favorite report card. President Donald Trump made shrinking the trade deficit a key goal for his trade battles. The U.S. trade deficit increased to its highest level since February and July. The goods trade deficit with China and the European Union, two of Trump's main targets, hit record highs. Soybean exports, one of China's main trade war targets, fell in July. President Donald Trump's trade war doesn't seem to have curtailed American appetite for foreign goods, at least not yet. Despite the imposition of tariffs and counter-tariffs in July, the U.S. trade deficit increased to $50.1 billion, a 9.6% increase from the previous month, according to the U.S. Census Bureau. The increase came on the back of a 0.9% increase in imports to a record $261.2 billion, as U.S. domestic demand remained strong. Exports, on the other hand, slipped 1%. For the year, the trade deficit increased to $338 billion, compared to $316 billion in the first 7 months of 2017. Trump has repeatedly pointed to the large U.S. trade deficit as one of the primary reasons his administration has embarked on trade fights with China, the European Union, Canada, Mexico, and more. But in addition to the overall deficit, the goods trade deficit with both China and the EU hit record highs. In the month of July, the goods trade deficit with China increased to $36.8 billion, as imports jumped 5.6% and exports stumbled 7.7%. Similarly, the deficit with the EU hit $17.59 billion, as imports ticked up 2.5% and exports collapsed 15.7%. Ward McCarthy, chief financial economist at Jefferies, said the worsening trade deficit with two of Trump's main trade war targets could lead to more attacks from the president. These record deficits are likely both be a partial consequence of the ongoing trade/tariff war and a likely catalyst for increased trade tensions between the U.S., EU, and China, McCarthy said in a note to clients. McCarthy also pointed out that the trade deficit with Canada increased to $3.15 billion, a 58% increase from the month before and the highest since January. Of particular note, exports of soybeans fell by $700 million in the month of July, a 16.2% drop. Soybeans are the largest U.S. agricultural export, and China is by far the largest destination for the crop. China imposed tariffs on U.S. soybeans in July, and the pre-tariff surge in soybean exports appears to be reversing. But soybean exports through the first 7 months came above the same time period a year ago. The data show that while the tariffs may be having some marginal effect on exports, the surge in imports is mostly due to the internal strength of the U.S. economy. The U.S. consumer is in a healthy financial spot, especially compared to many other countries, and the strong U.S. dollar makes exports cheaper. Add all of this up and you have a recipe for a growing deficits. Ian Shepherdson, the chief economist at Pantheon Macroeconomics, said that given the variety of factors at work, the second quarter's decline in the trade deficit will most likely be erased in the current quarter. The trade deficit likely will be flat to higher over the next couple of months, reversing most or all of the second quarter's drop, which the president has cited as evidence of the success of his trade policies, he said. It wasn't. Things are not going to plan in Trump's U.S. trade deficit wars. The numbers are not looking good for a president who has made reducing the U.S. trade deficit one of his main economic goals. Worse still, signs are emerging that President Donald Trump's trade wars are starting to hit economic growth, not just at home, but around the world. New data out Wednesday showed the U.S. trade deficit in July widening at its fastest rate since 2015 as monthly deficits with China and the European Union both hit new records. In the year so far, the U.S.'s overall goods and services deficit is up by $22 billion, or 7%, versus the same period last year. The data coincides with Trump's moves to escalate his battles with China and efforts to badger Canada into signing on to a new NAFTA, highlighting what economists have argued is the incongruity of his trade policies. Even as he launches his battles in the name of reducing the U.S.'s imbalances, he has been causing the overall deficit to grow by increasing public spending and encouraging domestic investment. The policies of this administration are policies that may not have been designed to increase the trade deficit, but that is their effect, said Philip Levy, who served on President George W. Bush's Council of Economic Advisers. Policy distortions. Also apparent in the trade data are some of the distortions that Trump's policies have been fueling, and how they may be helping mask the long-term impact of his trade wars. While soybean farmers are widely seen as one of the likely victims of a trade war with China, for example, a surge in exports of soybeans to get ahead of new tariffs helped boost U.S. GDP growth in the second quarter. In the first 7 months of this year, the value of U.S. soybean exports actually increased by more than 40%, or $5.7 billion, versus the same period last year, according to the data released on Wednesday. Those distortions are likely to be temporary. And that is why many economists believe U.S. GDP growth may have peaked at 4.2% in second quarter, with trade likely to be a drag on growth in the months to come. Modest drag. Andrew Hunter of Capital Economics said the trade data released on Wednesday indicated that after boosting GDP figures in the second quarter, net exports would subtract from it in the second half. In the third quarter, he predicted net trade would subtract more than a percentage point from GDP growth, while the recent surge in the dollar suggested that trade could be a modest drag in the fourth quarter too, even before the impact of tariffs starts to take hold. Most economists argue against Trump's characterization of the U.S. trade deficit as a reflection of the country's profits and losses from trade. They also tend to cringe when people invoke reducing the deficit as a policy goal. The last time the U.S. trade deficit shrank significantly was in the aftermath of the 2008 crisis, which saw a collapse in global trade. Trade policy has very little direct impact on the overall trade deficit in the longer run, said Mary Lovely, a Syracuse University economist. The new NAFTA, for example, is unlikely to do much to change the trade deficit, despite the administration's claims, she said. On the other hand, if Trump's trade wars eventually hit business confidence, it would certainly affect the trade deficit. Then we would see a reduction in the U.S. trade deficit, but of course with harmful effects on economic activity and employment, she said. The impacts of Trump's growing trade wars aren't limited to the U.S., they also have only just started to bite. At the World Trade Organization, Robert Koopman, the chief economist, fears that we are beginning to see signs of a slowdown in global trade growth linked to the trade wars. That matters, because just a few months ago trade growth was being cited as one of the main causes for a robust streak in the global economy. Around the world, manufacturing surveys are beginning to show a dip in export orders. Air and ocean freight data are pointing to a slowdown. So too is a dip in auto production around the world, Koopman said in an interview. More worryingly, he said, the world is already seeing a slowdown in foreign direct investment that is likely to lead to a longer-term impact on trade. It also is significant because, if anything, the Trump trade wars are only just getting started. More significant damage looms ahead, Koopman said, with the Trump administration expected to proceed with a new wave of tariffs on $200 billion of China goods as early as this week, and amid its threats to put national security tariffs on imported cars and parts. The real damage from those measures, and any retaliation from China and other U.S. trading partners, may not hit the global economy until the first quarter of next year, Koopman said. There has been a lot more talk than action so far, Koopman said. The worry is when the action starts happening. Trump's trade war with China is still raging. Here are the states that could end up getting whacked. President Donald Trump is reportedly set to impose tariffs on another $200 billion worth of Chinese goods. The move would be an escalation of the US-China trade war, and another step toward Trump's threat to impose tariffs on all Chinese goods entering the U.S. Tennessee is most at risk from a full-blown trade war, followed by Washington, California, South Carolina, and Kentucky. Check out the impact from a full-blown US-China trade war on every state, below. President Donald Trump's trade war with China could be about to go to the next level, and some states should be more worried than others. Trump is reportedly pushing advisors to impose tariffs on another $200 billion worth of Chinese goods as early as next week. The move would be a major escalation of the US-China trade war and result in roughly half of all Chinese imports to the U.S. being subject to tariffs. Beijing has threatened to impose tariffs on $60 billion worth of U.S. goods in response, and the moves could be a step to Trump's ultimate threat: tariffs on all goods coming in from China. Economists say a full-blown trade war, with tariffs on all goods between the two countries, would result in substantial price increases for U.S. businesses and consumers. Such a huge trade war would also drag on U.S. economic growth. But the pain from the trade fight would not fall equally across the U.S. To determine the biggest losers from an all-out trade war with China, we looked at the percent of each state's GDP that was attributable to trade with China. The biggest loser from a full-blown trade war with China would be Tennessee, as trade with China accounts for 7.6% of the state's total GDP. Following closely behind are 4 other states, where 5% or more of their state GDP comes from Chinese trade: Washington, 6.43%, California, 6.39%, South Carolina, 5.87%, Kentucky, 5.39%. The move also poses a political risk to Trump, since he won 17 of the 24 states where more than 2% of state GDP comes from trade with China. And in high-risk states, like California and Washington, many House Republican incumbents are facing hard challenges from Democrats. Trump reportedly wants to hit China with tariffs on $200 billion worth of goods, which would be a massive escalation of the trade war. President Donald Trump wants to move forward with tariffs on another $200 billion worth of Chinese imports to the U.S., according to a new report. The move would be a massive escalation of the trade war with China. Over 50% of Chinese imports would be subject to tariffs. U.S. stock indexes fell following the news. President Donald Trump is ready to take the trade war with China to the next level, according to a new report. Bloomberg reported Thursday that Trump had told aides that he wants to follow through on a threat to impose tariffs on another $200 billion worth of Chinese goods as early as next week. That would mean more than half of all Chinese imports would be subject to tariffs. The tariffs could go into effect after the public comment period ends on September 6. According to the report, the move is not a done deal, and the administration could impose the tariffs in installments to lessen the impact. Economists have warned that substantially ramping up the trade war would increase costs for U.S. businesses and harm American companies. The list of goods that would get hit with the tariffs is still being finalized, but the initial list showed a pronounced shift in Trump's trade war strategy. It included many consumer goods, such as fabrics and hats, while previous tariffs have focused mostly on industrial goods, like machinery. When Trump announced the possibility of the tariffs on $200 billion worth of Chinese goods, Beijing responded by threatening tariffs on $60 billion worth of U.S. goods. If those measures go forward, almost all U.S. goods heading to China would be subject to tariffs. Following the report, U.S. stock indexes slid, with the Dow Jones Industrial Average off by 143 points, or 0.55%, as of 2:25 p.m. Eastern Time. Here's a timeline of the US-China trade war so far. March 1. President Donald Trump announces tariffs on all imports of steel and aluminum, including metals from China. March 22. Trump announces plans to impose a 25% tariff on $50 billion worth of Chinese goods. China announces tariffs in retaliation to the steel and aluminum duties, and promises a response to the latest U.S. announcement. April 3, the U.S. Trade Representative announces a list of Chinese goods subject to the tariffs. There is a mandatory 60-day comment period for industries to ask for exemptions from the tariffs. April 4, China rolls out a list of more than 100 U.S. goods worth roughly $50 billion that are subject to retaliatory tariffs. May 21, after a meeting, the two countries announced the outline of a trade deal to avoid the tariffs. May 29, the White House announces that the tariffs on $50 billion of Chinese goods will move forward, with the final list of goods released June 15. The move appears to wreck the nascent trade deal. June 15, Trump rolls out the final list of goods subject to new tariffs. Chinese imports worth $34 billion would be subject to the new 25% tariff as of July 6, with another $16 billion worth of imports subject to the tariff at a later date. China retaliates with an equivalent set of tariffs. June 18, Trump threatens a 10% tariff on another $200 billion worth of Chinese goods. July 6, the first tranche of tariffs on $34 billion worth of Chinese goods takes effect. China responds in kind. July 10, the U.S. releases an initial list of an additional $200 billion worth of Chinese goods that could be subject to a 10% tariff. August 1, Washington more than doubles the value of its tariff threats against Beijing, announcing plans to increase the size of proposed duties on $200 billion worth of Chinese goods to 25% from 10%. August 3, China says it will impose tariffs of various rates on another $60 billion worth of U.S. goods if Trump moves forward with his latest threat. August 7, the U.S. announces that the second tranche of tariffs, which will hit $16 billion worth of Chinese goods, will go into effect on August 23. August 23, the U.S. imposes tariffs on another $16 billion worth of Chinese goods, and Beijing responds with tariffs on $16 billion worth of U.S. goods.